Look around, folks. You clock 18 hours of overtime at the plastics plants just to keep your pantry stocked with ramen. Your F-150 payment is a hostage situation, and the dollar in your wallet has the purchasing power of a Chuck E. Cheese token. That is the reality here at the end of 2025 as we go into 2026. And Washington prints cash like a carnival barker, puking tickets. Wall Street is gobbling up all of the hard assets, and you get a cost of living raise that cannot even cover the price jump on your Newport cigarettes. 2026 is where this freak show reaches the main event for Bitcoin. Remember last April when the Bitcoin network chopped its supply in half again? Think of every single coal mine on Earth sealing half of its shafts overnight, while BlackRock, Fidelity, and every pension fund suit with slicked back hair fights over the remaining lumps. That is happening, but right now with digital gold. We're going into 2026, and we know that Congress has finally figured out how to spell the word Bitcoin. They've stamped Bitcoin as a commodity. Remember, the SEC's buzzkill hall monitor is off our backs, and now the CFTC is handshaking it like soybeans. Banks are wiring up pipes so you can plop sats down as collateral for a loan faster than your cousin can Venmo you bail money. And then we have the Fed whispering about rate cuts. We have the AI giants torching $1 trillion, buying GPUs that suck electricity like they are NASCAR engines. And every single financial analyst who laughed at us in 2018 is now begging to get in on the Bitcoin glory. The music has changed, the chairs are vanishing, and the only seat left has orange upholstery. So I'm going to lay out the bull case for Bitcoin in 2026, and I need you to ask yourself, do you want to ride shotgun with Larry Fink while he hoards the future of money, or do you want to keep trading your life force for an IOU that expires faster than milk in August? The reality is that we've never seen a more structurally bullish setup for Bitcoin in the history of the asset, and Bitcoin is the working class exit ramp from the carnival of fiat misery. All right, let's put on the nerd goggles for 60 seconds because the numbers are where the magic happens. Right now, we're getting 3.125 BTC per block. That's all the new Bitcoin the planet gets every 10 minutes, about 450 Bitcoin per day. You could fit a whole day's issuance of Bitcoin into a single Walmart parking lot meetup and still have trunk space for beef jerky. That's 164,000 Bitcoin a year. At the same time, Uncle Sam printed $6 trillion out of thin air in one stimulus binge. One of these is a capped resource, and the other we all know is monopoly money with slightly better graphic design. And as we look at the Bitcoin supply issuance, that's a sub 1% inflation rate, 0.9%. We know that gold is running at 1.5 to 2%. The dollar's official CPI is 2.7%, but we know that they lie about inflation all the time, and realistically, it's a lot higher than that. And we all know that your grocery bill actually shouts 25% plus inflation. So right now, we know that Bitcoin is already harder than gold and trending harder every 4 years because of the halving. And when we're looking back on 2025, what happened? We saw the ETF Hoover effect. BlackRock and friends, they inhaled over 500,000 BTC in 12 months, more than triple the entire new supply for the year. More than triple the entire new supply for the year. And we know that a lot of people have been taking profits now that Bitcoin has been this accepted. We are finally seeing the liquidity in the asset required to take lots of profits in USD without tanking the entire market. But the reality is that the float of Bitcoin is getting thinner than airline legroom. This is reality. Look at the rough math. Fewer than 2 million BTC remain on exchanges right now. If every American earning under $70,000 wanted just 0.01 BTC, the shelves would be cleaned out twice over. So when we just look at the update at the end of 2025 on the scarcity metrics of Bitcoin, we still know that the supply is running on a schedule tighter than a Marine's haircut, while demand follows the largest asset managers on planet Earth. So when a scarce asset meets that vacuum cleaner, price does not become a mystery. It becomes a math equation with one variable left to solve. So get your piece of the network before the spreadsheet at BlackRock does. Now we need to talk about institutional demand reaching critical mass because that's exactly what's happening. it is time to follow the smart money because the cavalry has already breached the walls. When we look at what the ETFs were gulping down in US dollars, $45 billion in net inflows in 12 months. BlackRock's IBIT alone is soaking up Bitcoin faster than Bud Light at a county fair. The spreadsheet crowd has spoken and they want hard collateral and not hollow promises. And when we look at the total hoovering, that controls 1.4 million coins as of now, 7% of everything that will ever exist for the network, and that number just continues to grow. Larry Fink is putting a velvet rope around his stash of Bitcoin, and you are on the outside of the club unless you brought your own ticket. And we know that the retirement accounts are just now opening the floodgates. If you look at the recent news, Fidelity and Schwab, they quietly added Bitcoin lanes inside of their 401ks, and guess what? So did Vanguard. So we're going into the new year with every single HR brochure in America now ticking a box marked digital commodity, and millions of payroll deductions start dollar cost averaging without a single meme tweet. And we see the corporate treasuries out there, they keep stacking like prepper food buckets. Michael Saylor buying $1 billion plus of Bitcoin almost every single week still. We've seen Strategy park 670,000 BTC just by itself, and all the mid-cap companies in the S&P 500 are eyeing that playbook because nothing says hedged like owning the hardest money ever engineered. So the takeaway from this is pretty simple. The Fortune 500 boards, the pension committees, and payroll, they are all going to be auto-investing. Their straws are going to be plugged in to the same orange milkshake here. So you have a choice. You can sip before the tanker trucks arrive, or watch the gauge hit empty while analysts call it rotation, your move. And if you're not bullish yet, you just gotta look at the regulatory green lights, because this is where Washington has started to do something useful for the first time in 250 years. FIT 21 cleared the House 279 to 136. What does that mean? Well, for context, we know that Congress can barely pass a resolution honoring mom on Mother's Day, yet they managed to plant a flag that says Bitcoin is a commodity. That vote count is a neon sign to every compliance officer in America. And so now the CFTC can take the wheel, the agency that already referees wheat, copper, and frozen orange juice. Now they get to babysit Bitcoin. Silicon Valley calls that product market fit. We know that the SEC security label is off the table, which lets the exchanges and all of the brokers breathe again when they want to deal with Bitcoin. And we have safe harbor disclosures baked in as it relates to Bitcoin. All of the startups in the world, they get a clear runway to launch, report, and mature before dropping on the retail crowd. The custodians of the asset out there, they get a checklist. That means that insurance companies can actually price risk, and auditors will stop squinting at 50-page memos. And we know that the Senate Ag Committee begins the markup in February. And now that calendar date in February matters because institutional desks, they key their risk models to legislative clocks. When the markup completes, we get a regulatory finish line for Bitcoin, which Wall Street loves more than bourbon at a fundraiser. We are just seeing this total mind shift change inside of the Beltway here. The Treasury staffers, they now brief lawmakers on digital competitiveness. The reality is that Bitcoin is no longer a renegade. It is a strategic commodity sitting on the same shelf as oil reserves. This is what regulatory clarity is giving us. So regulation has moved from question mark to catalyst officially, and once the rules read like a driver's manual to the people who get to allocate to the asset, we know that capital exits the on-ramp doing 90 miles an hour. So now that we know that regulatory clarity is totally underway, it is undeniable at this point, let's talk about how the big boys are wiring Bitcoin straight into the financial sewer system and why that matters to anyone who's tired of overdraft fees. We know that JP Morgan's Onyx division quietly flipped the switch. This literally just happened at the tail end of 2025. Hedge funds can now post Bitcoin as repo collateral, and it can settle in minutes and then they can unlock margin before their coffee cools. So when the largest US bank treats sats like they are treasury bills, the rest of the banking cartel starts to take notes. So what did we see? We saw Citibank, we saw Bank of America, we saw Wells Fargo, and we saw BNY Mellon. They joined pilot programs. They are testing BTC-backed credit lines and real-time collateral mobility. Wall Street is stress testing Bitcoin on purpose instead of pretending it doesn't exist anymore. We know that the Basel crypto caps are under active review, which are the banking standards for asset holding, which the credit models actually follow to look at their guidance for what they should rate companies. And we all know that default probabilities when you have Bitcoin, they're a lot lower than junk bonds, and haircut models are holding up. So if the Basel frameworks raise the ceiling, the balance sheet velocity that goes into Bitcoin is going to spike, and banks that pass stay competitive. And people that know the true value of Bitcoin, they understand that settlement risk is just going to collapse for any entity that holds Bitcoin, because moving collateral by wire takes hours and sometimes days if the Fed wire window closes. We know that on-chain transfers arrive in one confirmation around 10 minutes, and Lightning rails squeeze that down to seconds for smaller lots. Overnight funding desks love speed more than any arbitrage. And once the rails are proven, that means that the Fortune 500 CFOs can pledge Bitcoin to shore up commercial paper programs, municipalities can issue bonds with BTC escrows, and pension funds can rehypothecate sats for cheap leverage instead of rolling repo in perpetuity. So you might be asking, Adam, what does all of this mean? What I am trying to illustrate to you is that banks are rebuilding their plumbing around Bitcoin, an asset with a hard cap. And as the collateral demand continues to scale, the circulating supply of Bitcoin continues to shrink, and then price discovery turns into a price revelation for us all. So stack before your mortgage lender does. So now we need to look at the macro tailwinds and the network strength of Bitcoin right now. Let's look at the big picture first. We know that central banks in 2025, they sliced rates by 850 basis points worldwide. And we know the plan is to continue cutting rates throughout all of 2026. Liquidity is back on tap, and cash is going to be sprinting out of money market funds looking for something that outruns inflation. We know that Trump in the White House, they're lobbying for a 1% Fed funds rate. Trump himself has said this, and cheap borrowing, that juices asset prices, and hard assets take the biggest gulp. Because remember, supply can't flex. Bitcoin has the hardest supply curve in existence, and they get to benefit disproportionately. We know that the AI giants are going to throw $1.5 trillion at data centers in 2026. Every single hyperscale server hall needs electricity like a corn farmer needs rain. That is what they need to function, and that bid under the power market drives commodity inflation and reminds investors that energy-backed money beats paper IOUs. And then when you look at the network itself, we crossed the 1 zettahash mark in 2025. When we look at the hash rate, what a milestone. We're talking exabytes of proof of work every 10 minutes, secured by stranded hydroelectric power, flare gas, and nuclear overflow that used to sit idle. All of the ESG critics in the world have to find a new boogeyman because Bitcoin's grid mix is cleaner than many nations' household averages. And why is this beautiful? Because the security budget is rising while the issuance of the asset is falling. So the miners earn more fees plus higher price, so chain security tightens even as new supply shrinks. Name another asset where protection improves while dilution drops. So let's wrap it up. We have cheap money. We have massive AI-driven energy demand. We have instant payment rails. We have record-setting security, all converging at the same time as the institutional adoption and the regulatory clarity coming from the government. That is gasoline, oxygen, a spark, and a sealed container all packaged together in one glorious present for you. So when we look to 2026, the outcome for Bitcoin isn't based on luck, kids. It's literally thermodynamics wearing an orange jacket. It is inevitable. Time to put some numbers on the scoreboard because we love talking about the Bitcoin price. I'm talking 3 scenarios, same playbook. Scarce asset, growing vacuum. We have a conservative case of $125K per Bitcoin, assuming the ETFs can only add only 350k BTC next year. That's assuming that the bank pilots stay capped while the Basel nerds crunch their spreadsheets and actually don't give any guidance around Bitcoin as an asset. This is still going to push the price past 6 figures because new issuance can't keep pace, and all of the 401ks, they're going to have a drip feed piling on top. And then with the base case, I'm talking a conservative 600k BTC inflow. We have the Senate finalizing the Clarity Act. We have the CFTC rulebook hitting the Federal Register. CFOs start to pledge their sats for working capital lines, and we have federal rates drifting to 2% or below. Cheap leverage is going to fan the flames for Bitcoin. Historical elasticity from prior halvings drop right into this range. And then my fun stretch case here, we're talking 1 million BTC inflown for the ETFs. We have broad bank adoption. We've seen Michael Saylor meeting with the banks, JP Morgan, Morgan Stanley. What do you think that means? At this point, Bitcoin's going to trade like a beachfront property in Manhattan. Price discovery becomes an auction for the last available square foot. This is where things get exciting. Every single scenario that we are looking at in 2026, it really presumes zero miracles, just already very visible catalysts playing out on schedule. So you can decide whether to own a ticket in the cheap seats or walk into the VIP lounge before the velvet rope snaps shut. Stack accordingly. This is the year for Bitcoin. The orange singularity is inevitable. And if you want to be positioned before the incoming orange singularity, Swan Private is for you. Swan Private works with high net worth families, individuals, and companies building generational Bitcoin positions securely, strategically, and with real macro insight. Because the goal isn't to trade the next spike, it is to own the foundation before the rotation finishes. Visit swan.com/no-second-best to learn more. Like this video and subscribe to Swan as we bring you daily Bitcoin insights during the greatest wealth transfer in the history of humanity. Humanity is migrating toward the orange gospel because they want hard assets that are immune to deflation, and Bitcoin is the apex asset that nobody will be able to get enough of. Have a terrific day. Do not party too hard. Class dismissed.